All right, so let's begin. Welcome everyone to East State Academy's Income Tax Part 1, What Your Client Needs to Know. I'm joined by Ian Hull. Welcome, Ian. And before we get too deep into it, do you have any preliminary comments on our topic today?
Yeah, I was thinking about this, and one of the things that the way we've structured this is what the client needs to know. But the subtext, of course, is what do we need to know? And I harken back to all of us who went through law school. Those of us who didn't stay in the dark world of tax, it really comes down to issue identification. And we hope to start sort of highlighting that today, because we don't need to know the deep understanding of all of the nuances of what shares are going to transfer where on an estate freeze or something of that nature. But if we get some of these things, concepts, if we can really focus our own needs on the level of tax that we're going to require to know, because it helps simplify, I think, with our clients. So I just want to issue identify, and that's what I hope we're going to focus on mostly today.
Yeah. And we deliberately entitled it "What Your Client Needs to Know," because they're going to learn it from us probably, and we may have to send them what they might need to know. Is they need to know more than we can tell them. I, for one, am no tax expert and know just enough, hopefully, to spot the issues and get them in the hands of somebody who knows about it. So the first thing, and that really ties into that point, Ian, is, what are our requirements as a will planner as far as knowing tax? This is some language that I use in my reporting letter that confirms that, I'm not retained. I don't say I'm not retained to provide, any tax advice. I say any income tax planning advice, because I think it's going to be incumbent on us, if we're drafting a will, that we know enough about it. We have to give some tax advice, in the sense we're going to be assumed to know that an RSP is going to trigger income tax if it doesn't go to a spouse. That kind of basic thing. But what I'm not going to give is income tax planning advice. You should structure your affairs this way or that way. What do you say about that? Ian?
Well, there's 2 points I have. One is that this just ties into the importance of sending some sort of reporting, and certainly earlier than the later in the nature of the retainer, that you've set the parameters of the scope of what you're able to do. And secondly, I really do like to spend some time delineating between that, to say, look, I'm not afraid to identify what tax issues we've got to be mindful of, but I'm not going to identify the planning steps. And I think it gives the client some comfort that you're not going into it blind and sort of expecting them to go to their accountant every time they do a will. But at the same time, you're setting the retainer parameters, which is crucial, and it needs to be done in writing.
Yeah, and I've never actually had much of a pushback from clients about this. I think I make it clear, first of all, in my retainer agreement that I'm not, and we may need to bring in some experts. So I think it's really important. So again, this is sort of focused on what does the client need to know, and therefore, sort of how can we make it simple for the client to understand. And this is sort of how I would approach it. And the fact that, death is going to trigger this notional sale of assets. And most people understand that when they sell the asset, that might trigger capital gains if the value of the asset is increased. So, okay, we've got capital gains. And of course, the way our system works is that only 50% of the capital gain is typically included as income. So that's already a discount. And so you've got 50% of the capital gain being the income that's included in your client's, the deceased's tax return, their final tax return. Ian, do you want to jump in at that point first before, do you have any comments there?
Again, to simplify things, I always try to say, look, you're looking at 25 cents on the dollar. And, and it helps just sort of guide the client in terms of what their guideposts are and expectations. But again, even rough calculations of tax owing goes a long way to give the client a better understanding of what their overall estate plan is. And whatever tools you can use, even your own tools or your own calculations to give people rough ranges, helps drive the whole estate plan. And you know, sometimes you want to talk to a client who's maybe over exaggerating some initial gifts because they haven't really identified it clearly as to what really is going to be net left. So I like to take this opportunity to go through the concept.
So yeah, I mean, what I would typically say is, because 50% of the capital gain is taxable, and because the highest marginal rate is around 50%, you know, if you take 50% of 50%, you're at 25%. So if you take the capital gain, divide it by 4, that's the approximate amount of income tax that's going to be triggered on the death with respect to that asset. And the last point is crucial, and we'll come back to this again, is that, you know, the income tax, the burden of the income tax is on the residue. It gets paid first from the estate before any gifts go out. And it doesn't follow the gift. So it doesn't follow the asset necessarily. And we'll talk some more about that. That's where we can really get in trouble, is that the income tax that's triggered on death of a particular asset is paid out of the residue and doesn't come out of the proceeds of that asset itself. But we'll,
yeah, I think we will talk some more about that, but that's obviously a big potential negligence claim as well.
Right. So that's the way sort of I explain it, that there's all these triggers, trigger the sale, trigger the capital gain, trigger the income inclusion, and then trigger the income tax. So then there are, of course, assets that don't trigger income tax at death. And so we've got the certain assets which have no capital gains. They don't appreciate in value. So cash, for example, $1 billion in cash, it's after tax money. It doesn't go up in value. There's income perhaps, but it doesn't appreciate. A dollar is a dollar. And so there'd be no deemed notional sale of that asset on death that would trigger any kind of capital gain. Similarly, with assets that are just income producing and don't go up in value, so a GIC, for example, those kinds of assets, we're only really concerned about assets that are going up in value or have gone up in value since they were acquired by the client. And then we have certain exempt assets. The way I explain it is, imagine if you sold all of your assets tomorrow. You're alive, but you sold all your assets. Then what would happen is, would you pay tax on your principal residence? No. So you don't pay tax on your principal residence when you die either. And there are, of course, complicated rules about what qualifies as a principal residence and those kinds of things. But the key element for most people is that you can only have one within a relationship. So each spouse cannot have their own. It's one between a couple, and you can only have one at a time. So if you see a client that has a bunch of real estate, different properties, well, you know that at best you're only going to have one that's going to be a principal residence. And the other big one is life insurance. Life insurance is going to be income tax free. And we're talking about the death benefit at this point. So that's important. Those are sort of the key ones.
And I always make sure I pause with the client on the principal residence issue, because it used to be such a flaky point, right? Because until CRA started to tell us that we had to actually tell them what our principal residence was, we would be fairly loosey-goosey about it. And now I make sure that the clients consider that and make sure that they do talk to their tax advisors and do consider that issue, and not just sort of hope that it's going to work out in a year before death, make the decision.
Right. And yeah, I mean, I sometimes get questions about, is this a principal residence? Is this a principal? I just send them back to their accountant to look at all the, especially if they've been renting out a portion of, all of those kinds of things. So, but those are the big ones that the client needs to know won't necessarily attract tax. Now, what's the big one that's going to attract tax? Well, that's a registered asset. So an RSP, for example, or a RIF, or similar locked-in retirement accounts, things like that. So the big issue here, of course, is that the client has been getting a tax deduction for putting the money in, and when they die, the full value of the asset, not just the capital gain, but the full value of the RSP is taxable income. And we're going to talk about rollovers in a second, but that is a taxable event, and it's full inclusion. So whereas Ian indicated for capital gains, you take a quarter of the capital gain. In here, I would assume if an RSP was worth a certain amount of money, that 50% of it would be taxable, would be tax. Not all of it would be taxable, and 50% would be the amount of tax that has to be paid. So it's as if the client had withdrawn the entire amount at death. And clients sort of understand that. If you say, well, if you took out your whole RSP, you'd have to pay tax on it. Okay, that's how it works. Ian, anything there?
Yeah, it comes. That's an old rule too. So that's 50 cent dollars on that one, and it's a big number typically, and people aren't always ready for from a cash flow standpoint at the on the estate planning side. So it's something to always keep in mind. And so I like to make sure you throw that number at them, and then they get a handle on it quick, in terms of what to expect.
Yeah, and I get a lot of questions like, well, what can we do to avoid tax? Well, we're going to talk about that right now. Now, as Ian said, the ability to pay the tax is an issue if you're giving the RSP to somebody specific where there's no rollover, and there's going to be this big trigger of tax. And the burden, again, is something we'll talk about shortly. So when we're going through assets with clients, Ian, this is estate planner, but this is the way I would do it. I'd have, this is Homer Simpson's asset. So I'd sit down with Homer, and on the screen, I'd show them, here are your assets. And I'd work in the income tax just as rough numbers. Of course, this is just for illustration purposes. It's just rough. The clients, I've never had a client say to me, I think it's going to be closer to $5,325, because I make it clear to them it's just a rough idea. And it's helpful because, they want to know what's going to happen on death. That's part of what they're trying to plan for. And so you can see for the RSP at the bottom of that table, I've put in 50% of the value of that as income tax. Whereas for the investment portfolio, I'm saying, well, maybe it went up by 100 grand. And so if the capital gain was 100 grand, there's $25,000 of income tax there. And the client can get at least a sense of what's going there. And I'll show you in a moment about planning with that. Ian, anything you want?
And this is a really important exercise I find for me to go through, because that helps inform the client in terms of not just funding, but where the funding is going to come from. Some people will turn to me and say, well, look, I'd rather the residue pay it, and this is how it works. And they understand that, but they may not understand that the function of the tax payable and the source of it can drive many of your planning decisions. So I think it's an important roughing out the number based on rough calculations.
Yeah. And just to sort of demonstrate, can you see state on that, Ian?
Yes.
Okay. So this would be an example. I've got Schitt's Creek here, but this would be an example of saying to the client, okay, here are your assets, here's your income tax. Let's talk about trying to reduce that. And what we're going to show you, you can say to the client, is by doing certain things, we can get rid of tax. When you say, how do we get rid of this tax? Well, for example, RSP going to the spouse is going to automatically reduce the amount of tax that's payable. So just by doing that, we've saved $200,000 of income tax. So demonstrating the impact of that is useful for the client to see how they're planning and the income tax sort of meld together. And we'll come back to that in a moment. So then let's talk about the most common deferral, right? This is really, we don't have that many tools in income tax planning. And the big one is if you've got a spouse, you can use the spouse for as a beneficiary and get a deferral. Now, the important point is that it's a deferral of tax. It doesn't save the tax, it doesn't get rid of the tax. It's just a deferral. And it's a deferral of that tax until either the asset is sold. So if you think about a stock that's gone up in value, and if you died owning that stock and you didn't give it to a spouse, you trigger the capital gain on that stock. By giving it to a spouse, you're deferring that capital gain until the spouse disposes of that. And then we've got the sale of that and the capital gain triggered at that point and the income tax triggered at that point. And the other triggering event is the death of the second spouse. So you're deferring it until one of those two things happens. And what are our options there? Well, we've got the option of just giving it to the spouse. And if you give it to the spouse, that asset to the spouse, and it doesn't have to be a specific gift of that asset. It can be part of the residue. If that asset flows to the spouse, absolutely, you have that deferral until they sell it or until they die or give it away or transfer it or whatever. And the other option is a qualifying spousal trust. So you might say, well, I want to get the deferral, but I want to have some control over that asset. I don't want to give it to my spouse with no strings. And so you also get this deferral if you put that asset into a qualifying spousal trust. And there are three key elements. There are more, but these are the three key ones. First of all, it's got to be held for the lifetime of the spouse, okay? The trust. Second of all, the spouse has to get all of the income that's generated from that asset. And third, no one can access the asset itself, the capital, until the spouse dies. So those are the three components. So you can't hold, and we could talk some more at another session about qualifying spousal trust, but you have those two options, and those are the most common deferrals. Ian, do you want to jump in on that?
Oh yeah. Well, look, I mean, I think you made the point so strongly. So there's not a whole lot of choices, and quite frankly, the choices are probably going to get less, or they're going to be more. I mean, the governments are going to be looking for sources more and more. But we're going to come to it, and I think it's probably worthy of at least a half of a seminar alone on the qualifying spousal trust. But that gifting plan carries some drafting issues, but it also carries big issues relating to control. And so, these deferrals, I don't want to underestimate their importance from a tax standpoint, but sometimes we let the tax wag the dog, so to speak. And a good discussion has to go into the qualifying trust.
Well, that leads me right into the other considerations. So and you just hit on the very first point, which is, these are the considerations that the client has to be aware of when we're talking about tax issues. And the first is, wishes first, and then income tax deferral second. So what do you really want to happen to your assets? Don't give it to your spouse, even though you don't want your spouse to get it, just to defer tax. Because, once they also understand that this is just a deferral, that might be less important to them. There are liquidity issues to pay the tax and things like that, but wishes come first in my view. Ian, that sort of keys into your point there. The second point is, I think, one of the biggest ones, and that's that the burden, as I said, rests on the residuary beneficiaries. So, for example, if we're not giving an asset to the spouse in this scenario, we've got the cabin going to David. Now, David, the cabin is going to trigger $50,000 of income tax in this scenario, okay? And we've got the gift going to him. And if our client just told us, oh yeah, I want David to get the cabin and then split the residue equally among all the kids, okay? So you might go ahead and do that, because the client's not thinking about these income tax issues. But the key here is that the income tax burden of the cabin doesn't follow the cabin, doesn't get paid by the beneficiary of the cabin, but gets paid by the residue. So if we did nothing here, we'd have the $50,000 tax coming out of the residue, which is not going just to the recipient of the cabin. And the guy gets the cabin at the full value. So what eState does, for example, is recognizes this as a gift and warns us that we have an income tax issue to discuss with the client. And maybe the client says, when we raise this issue with the client, well, I don't want that to happen. I want David to be responsible for the tax. So if he gets the cabin, he's got to pay the income tax. Okay. Now we don't have that issue anymore, right? And that is really a crucial one. It's even more dramatic, of course, with a gift of an RSP, because that's going to trigger twice the amount of tax. And I've said this before, and I'll say it again. Clients who come to you with instructions that they want a specific asset, whether it's an RSP or a cabin or anything, to go to a specific person, one has to always be careful and warn the client, say, why are we doing this? Because there are big implications from a tax point of view and who the burden has to rely on. And again, if the instructions are, no, I want David to get the cabin, I don't want him to pay the tax, I want the estate to pay the tax, then I would have a document, I'd have a note that made that clear. I'd put a note in here that says, client, insists that tax on cabin is borne by resident. And because that is something that somebody's going to raise, right? Anything on that, Ian?
And it's that inadvertence that inadvertence is just not tolerated. In terms of it is a expectation that you're going to be typically an expectation that you're going to be canvassing this issue with the client carefully and where that tax is being paid. And I don't think the courts will have much patience if we get caught in.
Right. The next point I had there was, assets with the highest tax to the spouse. Well, that and then one below that are important because, for example, if we're in the spouse scenario and we say, okay, we're going to give the RSP to the spouse because it's going to save, the most amount of income tax. Well, that's all great, except that when the tax is just deferred. And so the spouse is going to pay the tax as they withdraw the money. So this $400,000 or whatever it happens to be when Moira inherits it is not worth the same as cash of that amount. It's because every time she takes out money, she's going to have to declare that as income in her own tax return. And so, yes, it's fine to say, okay, well, we'll do that to defer tax because that's got a tax burden. We'll give that to the spouse. But we also have to consider the income tax burden on the spouse themselves. And that applies to all assets because, again, if they sell it, they're going to then pay the tax on it. So, Ian, any points on that?
No, I think you've covered the basics. I just, as I say, these are good, really important issue identifiers, and at the end of the day, need to be documented and need to be canvassed with the clients.
So then we have this other point is, and sometimes this is overlooked, oh, we got to do this. We got to give it to the spouse because we got to defer tax. But if the idea is that this asset is going to get sold quickly after death anyway, because they need the cash or whatever else, well, that's just a deferral until the sale. And so just something to be cognizant of. It's more useful if the idea is this asset is going to continue to grow for a period of time post your client's death. This consideration, and I've said it many times, it's a deferral, not avoidance. And so that has to be balanced. And then the other point is, and I've got this here about assets with no tax to non-spouse beneficiaries. So if I wanted to prepare a plan, the client wants something to go to the kids. You know, I got to look at my assets, and if I were going to give, if I had my choice of whatever I wanted, I would pick an asset that doesn't trigger tax to go to the kids, because there's not going to be a deferral available. So what's the first thing that comes to mind? Life insurance. Life insurance going to the kids. You know, that's going to be, and I forget who the kids are, but let's say David is the kid. The life insurance designation to him of that amount, if that's what they want, you know, it makes sense. If we got to get them 200 grand, this is a good way to get it to them. And that's why I always say to people who are entering into a second relationship with a new spouse, for example, buy as much life insurance as you can, because you're going to want to provide for your kids from a prior relationship and your new spouse. And life insurance is the best way to deal with that. So look at those first and see if that makes some sense.
Just on the life insurance point, I think people too quickly come to the conclusion that it's too expensive or you're not eligible. And I can tell you that, you know, I just see it time and time again where the life insurance products are more available than you think they are. Elderly people, you get a joint last to die, you can create.
Yep, great. So yeah, and so I think at the end of the day, you know, using the idea of tax and it having the client, informing them of what they need to know, and there may be more important other issues that need an expert, but the idea that they can see sort of what's going on with their plan and what kind of income tax is going to be generated. You know, that's useful for clients to get a real feel for what's going to be left over. And it is incumbent on us, I think, and Ian, you can jump to this, and I think you made this point that, you know, we have to know some basic level of tax.
Yeah, and it comes back to flow and consequences. Outside of that, you don't really have to have a deep understanding of the tax. But where's it going to flow and what are the consequences on the basics? And I think, I mean, you've identified these 7 or 8 items that are so crucial within the framework of what we will probably be expected to have a general understanding of.
Yeah. So that takes us right to 1 o'clock. If anybody has a quick question for us, you can post it in our chat, and hope that this has been a good refresher for many of us, and maybe a few key points out there that we might want to emphasize to our clients. So thank you, Ian. Thanks so much.
My pleasure, Jordy. Good to be here. And now I'll let you field all the questions.
Thank you. So a couple of ones, just the idea of, well, some other questions, but yeah, I do include, somebody's asking, in my first interim report to clients, I include the visualization summaries and indicate that they're directional and recommend tax advice. So that's precisely what I do. Thanks, Fred. Yes. So the presentation will be shared, and it will be available to view, and the slides will be sent by Michaela. And we hope to have you guys back again next week. And we probably won't do another tax one. I can only handle one tax thing a month, I think. But I do want to give a heads up that Dr. Schulman, who's going to talk about capacity and capacity assessments, is coming in March. And so that's a very exciting for us. And he'll be our first guest at East State Academy. So hope everybody has a great afternoon, and we'll see you again. Thanks again. Bye-bye.